Hello and good evening. Welcome to the Specialty Dental M&A Market Update. I'll be your host, Kevin Cumbus. Tonight, we're going to cover really all the increased demand that we're seeing on the buy side in the specialty space. There has been a ton of demand over the years for general practices, really kind of started by Heartland Dental and the like. But the demand in the specialty space has it's ballooned like we never expected to see, and just felt like we had to get this information to you so you can understand what we are seeing from our vantage point. Quick update for those of you who don't know, I'm Kevin Cumbus, president of TUSK Partners. We work exclusively with doctors that are looking to sell their businesses to either private equity groups or larger DSOs. And I'm grateful that you're here on the call this evening. Stop. I got to clear this one up. Before we get started, I think it's important to share with you a little bit about TUSK. We are a collection of individuals that have a vast amount of experience in finance, investment banking, private equity, and mergers and acquisitions. So we collectively have worked at all these wonderful collection of companies over the years, and we also have deep specialization inside of the dental DSO healthcare space. So we're a unique collection of team members who really truly understand value creation inside the DSO space and individual practice space from both the buy side and the sell side. But really, where these two worlds intersect is exactly where TUSK lives. High level, 18 members, 30 plus years of dental experience, over $600 million of dental deals closed. We cover 100% of all specialties. And most importantly, the average improvement in deal terms over an initial unsolicited offer. So when doctors come to us with an unsolicited offer in hand from a DSO, we're able to increase that by about 41%, which is certainly meaningful. So all those stacks of unsolicited offers you have in your hands, by working with us and going through a marketed sales process, we have a history of driving those numbers up. A little bit about our success in the space. Just wanted to look at three verticals here: oral surgery, orthodontics, and pediatric dentistry. On the upper left-hand side there, 3-location, 3-doctor group. We sold for over 250% of revenue. 1-location, 1-doctor oral surgery group, over 202% of revenue. You'll notice in each of these deals, the doctors are not selling 100% of their business. They're actually rolling equity into their buyer. And the expected return on equity is down below. This is something we're going to come back to a little later in the presentation, but the valuation is important in these deals, but the value of the equity ultimately can be worth as much or more than the original sale price. So in oral surgery, again, over 250%, over 200% of collections. In orthodontics, 2-location, 2-doctor group sold for 280% of revenue. The expected return on the equity is around 4 times. A 1-location, 2-doctor group sold for 270% of revenue. Expected return on equity is 4.3 times. In pediatrics, 8-location, 16-doctor group, about 300% of revenue, and 1-location, 1-doctor for 160% of revenue. These are kind of the headline numbers. The devil is in the details on each of these transactions. We're going to help you understand how, kind of what the details are as well. So really could not be happier for our clients here, and obviously proud of our team's success in helping them achieve such rich valuations with really, really great partners in space. Before we dig too deep, I think it's important to always reference what's going on in the dental economy and what's driving the consolidation inside of the dental industry. From a historical perspective, Private practices have been about 75% of the market. That's a single location doctor. The mid-market, somewhere between 2 to 25 locations, has represented about 13% of the market. And elite groups, 25 plus locations, has represented about 12 to 13% of the total market. So what you see here is an estimate that we're about 25% consolidated. So when you're driving around town and you see, all the dentists' marquees and signs, you don't know whether or not they are affiliated with the DSO is the short story. Most of the DSOs are relatively invisible from the public eye. Dentists aren't advertising that they've decided to work with a DSO or sell to a DSO. They don't change the name. They don't make a big public announcement. So it's really, really hard to tell how consolidated the space is simply by driving around. What's going to happen in the next 5 years is what really is fascinating to us. Because on the private practice side, we expect to see this grow at about 1% per year compounded annually. But because the other areas of the market are consolidating so quickly and growing so rapidly, it's only going to represent 60% of the market over the next 5 years. In the middle market, this is the fastest growing segment inside of dentistry. Really, these are doctor-founded, debt-funded groups, groups in your area, doctors that club up to create groups. They'll be growing at about 12 to 15% compounded annually to create about 25% of the total market. And then in the large elite groups, they'll grow at double-digit rates compounded annually as well, and ultimately reside at about 15% of the market. This includes the consolidation that we're seeing in the specialty space. So the business model for specialists are going through some pretty seismic changes right now. A specialist, and let's just think of an orthodontist here for a moment, has over the years really grown accustomed to receiving referrals from, let's say, pediatric dentists. I know my dad's a pediatric dentist, and he sent a lot of referrals to a handful of excellent orthodontists in the city of Montgomery over the years. And that orthodontist's hope was to maintain that relationship with the referring partner so those patients would continue to come and he could continue to take care of them. As DSOs have come into the market, things have changed. And they've changed in a pretty meaningful way. First of all, specialists have learned over time that they need to market directly to patients, right? So this B2C marketing with direct mail, social media, gaining more of a presence in Google searches, increasing your 5-star reviews. So when searched, you are found. Specialists are having to build that muscle as anyone who is referred to a specialist, be it for an extraction of a wisdom tooth, a root canal, or for potentially braces for their child. Even though they get a referral, they are hopping on the internet to see who the best specialist in their area is and potentially disregarding that referral. The other challenge and headwind for specialists is many of their referring partners are being bought up by DSOs. And when they buy these referring doctors, those doctors are then financially incented to send their referrals, their patients, to other practices, other specialists that are within that same affiliated network. And what we're seeing is oral surgeons, endodontists, periodontists, prosthodontists, you name it, they are all seeing their referring partners bought up. And their patient base, they're starting to see signs of weakness around shrinking and concerns around the longevity and viability of their business. So on the buy side, there are plenty of buyers with plenty of capital looking to pay really nice, rich valuations to partner with you, and that's driving people to consider a sale. And then the truth be told, if you own one of these businesses and you're seeing your market shrink, there is an interest to maybe club together and sell to a group with some size, with some ability to help you grow, maybe with expertise around direct-to-patient marketing or a group that is affiliated with dentists who can refer you work. There are some curiosities out there around what are DSOs, what are invisible DSOs, what's going to change, what's going to stay the same if I do a deal with them. I'll start by saying if you've seen one DSO, you've frankly only seen one. I mean, they are all so different, and they're different in 100 different ways. But most of them today do not want to change the name in your practice. They do not want to alert your patients that there's been a change. They certainly don't want to provide clinical mandates to you, your associates, or your team, or tell you how to run your business. Over the years, there has been a real awakening, thankfully, from DSOs as they have looked to their predecessors and seen what has worked and what has not worked. And certainly what has not worked over time is a heavy-handed, top-down approach to telling affiliated doctors how to run their business. To saying, look, doc, I know you got a great brand here in town, but we're going to change it now to our brand. Because that's just, candidly, it's just kind of ego talking, right? If I'm going to force you to be in my brand, I'm saying your brand isn't good enough, you need to affiliate with mine. There's been a lot of learning that has happened over the years to get us to this point. So what do they want? They do want you to work post-sale for sure. And they absolutely want to keep your entire team in place, or at least the team that you want to keep in place. Turnover is costly. You know that. You've lost associates, team members. I mean, during the pandemic, we saw a lot of people lose team members. Currently, it's hard to recruit team members. That interruption is expensive. They recognize that, they know that, and they certainly don't want to see team members evaporate or get displaced during a transaction or transition. These deals are very different than a sale from one dentist to another. So in my former life, I worked for a company where we sold a lot of dental practices to individual dentists. And those transactions is really straightforward, right? We have a dentist who's selling his business and he or she is walking away after some minimal transition period. Could be a couple of days, could be 30 days, could be a month, but ultimately there's really one document. There's an asset purchase agreement. It's normally done with 100% cash, and there's no post-sale employment. These deals are very, very different because the buyer, in this case, is an investor. It is not a dentist. If for some reason you are sick, you, the seller, are sick, become disabled, or choose not to work any longer, the buyer cannot swoop in and see patients. And that's risk, and they identify that as risk, and they find ways to mitigate that risk through structure, post-sale employment, equity, and legal documents. By the time you have gotten to an executed letter of intent, all of these matters are still looming out there. So on structure, it's about how much cash, how much equity, does the equity come with distributions? Are there earnouts baked into your deal? Can they claw back my equity? And this is just really the tip of the iceberg when it comes to what all can be included in a structure. Post-sale employment is critical, especially for I would say younger doctors with a longer runway that are looking to work 5, 10, 15 years post-sale, because it comes with compensation. Attached to that are non-competes and non-solicits. And buyers are smart. They want to create a situation where you are financially incented and aligned to continue to work where you are rather than fight them on a non-compete issue. So these can get a little hairy. On the buyer quality, every buyer is different. Every single one. I mean, we talk with buyers all day, every day. And thankfully, there's some really, really good buyers out there, but not everybody is cut from the same cloth. They will all offer you equity as well. And I want to look at equity on the next slide, because equity kind of feels like this, kind of this vague term that no one seems to fully understand the value of. Some people say, look, it's worthless. There's no way it's going to come into being. Just look at the cash as close as the bird in the hand, and anything else would just be gravy. Others certainly believe in the equity and depend on the returns from the equity to secure their financial independence and secure their retirement. The good news is TUSK knows the good groups from the bad groups. We will tell you very clearly which ones we would invest in, which ones we would want to see our parents' money in or our money in, and the ones we wouldn't put enemies' money in. Not all equity is created equally. Finally, on the legal side, there are stacks and stacks and stacks of legal documents you will be getting through. You will certainly need to hire a qualified M&A dental deal attorney to help you with this process. But even inside of those documents, there's a lot of business points that need to be negotiated as well. Let's look at the equity here on the next slide so we can talk through it and make sure everybody understands a little bit on how these transactions work. Okay, so in this example, we're looking at a practice with revenue of about 3.8 million. There is in a transaction like this with the right profitability inside of it, certainly believe that a $5 million purchase price can be achieved, assuming low overhead inside the business and the right doctor mix. That purchase price, though, is going to be split in between two tranches. One is cash at close, and the second is equity. So on the equity side, so in this case, $4 million of cash, $1 million of equity. The cash you get at closing. The equity is an investment inside of the buyer, right? So you're going to take that $1 million and you're going to buy $1 million worth of shares inside of your new partner. That upper right-hand graph shows this entry price of $1 a share. Many times new DSOs will say, look, you're getting in on the ground floor. This is ground floor equity. This is where the founders have their equity or the private equity groups have their equity. This is the price at which you're able to get your equity. So you may hear ground floor equity thrown around. In this example, you're spending $1 million effectively to own 1 million shares. Now, what they're going to tell you is what they expect their returns to be. We spend a lot of time talking with buyers, leadership, private equity groups, and understanding not just what they believe it's going to be, but what their historical experience has been. And we certainly see deals trade at 5 times cash on cash return on the equity. It can range wildly above and below that. But in our example here, we're going to show $1 million of invested dollars into the business, turning into $5 million of total benefit from that equity. So in a deal like this, a dentist that owned $3.8 million of revenue over the life of the transaction was able to sell it for close to $9 million. Again, that's $4 million of cash plus $5 million of the total benefit of the equity. This is what's so compelling about these transactions. And this is why so many of your peers and colleagues have made the decision to partner with the DSO. The issue is the equity side. You don't really know where your suitor, the potential buyer or partner, is on their journey and what the likely financial outcomes are with respect to that equity. Here we've got 3 examples of this. In example 1, DSO 1 is showing an entry price of $1 a share and showing an increase to stop.
This relationship with them.
So again, the challenge is you don't know the likely financial returns on the equity that you're rolling into inside of your potential partner. I mean, these are 3 scenarios that we know of today in various DSOs. In one example, $1 to $7 expected return around seven times. This is a very likely case for a group that we're currently working with that we know who is a buyer. A Okay, I got to end it again. Yeah, the tricky thing is many times you don't know what the likely financial outcomes are for the equity that the DSO is selling you. We regularly see very, very rosy projections about what they believe their equity will be worth in the years to come. But we're able to layer in experience around what we have seen over the years. So it's not uncommon to see someone project 7 times cash on cash return on equity. It has been hit before, and we certainly know that there are buyers out there that we think have a good chance of returning something comparable. More often, we'll see about a 3 to 4 to 5 times cash on cash return on the equity. But sometimes you'll see something as paltry as like half of a return on equity. So I mean, it's really, you've got to do the homework and you've got to understand what's out there. And when you're only working with one buyer, you're only stuck with one likely outcome. So we bring buyers of all shapes and sizes with various purchase prices to help our clients not just understand the purchase price, but absolutely the return on what their equity could be, which again can be worth as much or more than the original cash at close. In the specialty space today, there are more buyers than there ever have been. So when you're looking at oral surgery, ortho, pediatric, perio, prosthodontics, endo, pedo, ortho, multi-specialty, there are certainly specialty specific DSOs for each and every one of these specialties. There is a group, there are many groups actually, that only want to partner with oral surgery groups. That's all they want to partner with. They have no interest in anything else. There are also groups that certainly want to partner with oral surgery groups, but they also want to partner with pediatric and orthodontic groups. And that's their sole focus, pedo, ortho, OMS. So that you can really find a wide array of buyers across every specialty in the nation. Those multi-specialty DSOs sometimes include GP groups that are looking to add specialty. So you look at companies that have been around for a long, long time, like Dental Care Alliance, for example, are now working with all specialties across the U.S. in areas where they have high concentration of potential referrals. So you got to think about the longevity of your business, right? So if you believe that if you're an oral surgeon and you believe that affiliating with a group that only connects with oral surgeons is best for you, then you found the right partner. On the other hand, if you believe that partnering with a group that it cannot just pay you a handsome sum for your practice, but can also help feed you referrals in your region, then you might want to consider a multi-specialty DSO. Finally, there are private equity investors that are continually looking for opportunities inside the space. Now, they're looking across every specialty, every state, and really trying to find the right group that they believe that they can help grow and scale. Normally, to be talking with private equity groups to get them excited about a transaction, your EBITDA, your profitability needs to be about $2 million or north, although we have seen them go lower. These are very, very different transactions than just partnering with a strategic. The expectations on the seller are different. The economics can be very different. The equity classes can be strikingly different. Look, every one of these buyers is going to come to you with a different structure. But I would say that those private equity deals have the most potential risk and issues in them if you're not a well-informed, well-advised doctor navigating that space. So the summary here is there are a sea of buyers for each and every one of you. And I know you've received unsolicited offers, but don't think they're the only game in town. When we work with clients and take them to market, we're able to put multiple offers on their plate each and every time. So if you're watching this webinar, there is no doubt over time that you have received an unsolicited offer, a phone call, an email, a letter has landed on your desk that says, I want to buy your practice. And congratulations, first of all, but I'll share with you, sadly, it's kind of hard to say, that doesn't make you special. Almost every dentist in America now with collections over $1 million with collections over $1 million have received an unsolicited offer. So what should you do when you get that phone call? So here's the thing. When you get the phone call, they want to know a lot from you. They're curious about your business, and the more information they can gather from you when you're unprepared, the better. Primarily, they're going to want to know your information about your financials and your operations inside of your business. You know, they've caught you at a moment where maybe you are between patients, or it's after a long day, or you spent a long day recruiting hygienists and 3 of them didn't show up. And maybe that's the time when you're like, you know what, I'm exhausted. I'll take a change. You know, I would equate this to, you know, thinking about, Austin, I want to do this one over. So when you get that call with the buyer on the other line, there's certainly some things, some ideas we have for you. They are trying to get as much information as possible from you so that they can inform an opinion around valuation. So they call, you pick up, it's been a long day, and you're like, all right, I guess I'm willing to share some information. Do not share your financial information at that point. Every business is in motion, and it's our guess that your financials tell a story. And maybe it's not the best story or the story that you want to tell at that time, but they're going to use whatever you provide them as the basis from their valuation and their offer. And if, you know, in a perfect world, they really want to pick up businesses before they are really ready to sell, pick them up where they're about to face explosive growth, and probably not have to pay for all that. You know, I equate it to, you know, someone, you know, we were going through a sale of our house, and before any buyers would show up, my wife would insist that we clean, and make sure the house was presentable. You showing your financials just at a simple request is likely the same way I would equate to showing your house with it being messy. It's not going to help enhance the value of the business or drive the highest valuation. They will also be asking a lot of questions. I encourage you to kind of flip the script on them there and ask more questions than you answer, so you can learn as much or more than they can. And finally, if you're really interested and you say, listen, this is something I would like to do, pick up the phone and give us a call. We are continually in communication with the market. We can survey the market to find you the right partner and drive up the economics to meet your financial needs. A term we use a lot around the office is asymmetric information. You know, because in asymmetric information exists in every single transaction out there. It represents the gap of knowledge that any buyer has on its seller, any seller has on its buyer. In this graph on the left-hand side, the target is you, right? They view you as a target. You're a dentist or a group contemplating a sale to unsolicited offer, and all you know about that person on the phone is what they're telling you. Unless you're Googling while they're talking, you don't have a heck of a lot of information. They, on the other hand, the buyer, have at least publicly available information about you. Anything that can be found online is what they know, and they are continually going to work to shrink their knowledge gap along the way. So here you are, the target, continuing the relationship. They've asked for some non-public information about your business, typically financial information, possibly operational information, and you begin to provide that. You're learning about the buyer. Maybe you've done a couple Google searches now. As they're working on your financials and gaining a deeper history about your financial performance, they're forming questions in their mind. They're finding opportunities for improvement. They're going away. I think that there's a real nice way here for us to increase revenue or decrease costs. And they're sending a business development person to come out, hop in an airplane, come spend time with you and get to know you. By now, they've taken you out to a really nice steak dinner at Ruth's Chris. They bought you a couple bottles of wine, and they're working to get you emotionally attached to the transaction, all while asking you questions about your business so they can shrink their knowledge gap. By the time it comes to them providing you an offer, they know as much or more about your business than you do from a financial and operational perspective. They are well-versed in your team, your turnover ratios, your strategy, your long-term growth, your vision, where your business is going. In many cases, the target doesn't know as much about the buyer. Again, they've had a lot of conversations with folks. Maybe, just maybe, they've reached out to some of the referrals that were provided by the buyer. But every time a buyer provides referrals to one of our clients, they're always glowing. They seem to always be glowing. So this gap here that the target faces, this knowledge gap, is what they're willing to accept in a transaction where they haven't brought an advisor in, they haven't surveyed the market, but they feel in their gut that the deal is right. Now, when targets turn into clients, that's where some magic actually happens. Because TUSK understands the market, we can certainly bring the best offer from the right partner. And our clients absolutely understand the risks and the rewards of the deal in front of them. What I love about this is the buyers also know that they have to compete. And when they have to compete and win, they really put their best foot forward. They sharpen their pencil to a pretty fine point to get every deal point they possibly can in the favor of our clients. They recognize that all of a sudden they're on rather equal footing with a peer across the table from them representing the doctor, and that they have to win not just on economics, but culture and equity. So TUSK levels the playing field when it comes to negotiating a transaction with the buyer. And really it's done through our knowledge and also going through a marketed sales process. We hear often from doctors who say, look, I've already got an LOI. I've already got a bid in hand. And again, it wouldn't surprise me if everybody on the call does. The way we think about DSOs is through a framework or through a lens. Because the offer, the price is interesting, but it doesn't tell you the whole story. So when we think about transactions, you can see on the left-hand side, we think about them in a scale. Price, absolutely important. The culture of the business and the cultural fit and alignment between the buyer and the seller is critical. Again, you are not walking away. You are sticking around post-sale to fulfill an employment agreement that could be 3 to 5 years. The value of the equity over time. I mean, is this equity going to zero or is this equity going to 5 times cash on cash? The reputation of the DSO or the private equity group and their experience in managing and working with doctors, building successful companies and building successful companies that actually exit. Across the top, you'll see that, on the left-hand side, you got pathetic. In the middle, it's average. And on the far right-hand side is enviable. No one wants a pathetic offer. My guess is everybody on the phone today is well above average. And, anyone selling their business wants to be in that enviable position. So doctors will come to us and say, here I am, I've got an incredible price. It is actually an enviable position to be in. And we'll take a look at the offer and say, wow, you're right. The price is, near market. And if that's the only thing you're focused on, I think you've got a good start here. But what they don't know, and what we know and what we can share with them, is that culturally it's probably not the right fit. And we do see some deterioration in the value of the equity. We understand the balance sheet has issues. We know that people are leaving that organization as quickly as they can, that there's leadership changes of control and leadership. The reputation outside of the city in which that doctor operates is not good. And we can share with them their experience and ability to exit is probably very, very low. It's these 4 characteristics down below the surface is where I'm certain we derive most of our value. Now, we can bring additional offers to the table that in some cases are not as high priced, but are much, much better fits and will provide better economic outcomes for our clients across all other facets, and even deals that are higher in price and have varying degrees of connection and alignment with our client. The point is, you need multiple offers at the table so you can maximize what's important to you. When you have the LOI and you're focused on the purchase price, it is really just the tip of the iceberg. I mean, this is just the beginning, because underneath that, attached to the other 7 to 10 pages of the LOI and the hundreds of pages attached to the legal documents, that's really where the deal is made. I mean, you've heard the devil is in the details. Well, that's absolutely true in transactions like this. Below the waterline, I mean, they have the ability to include things like callbacks on your equity, potentially retrading your transaction in the event that the quality of earnings doesn't come back as expected, creating earnouts where you have to hit high hurdles on revenue to receive full value, termination rights of your employment coupled with a non-compete to force you to leave the city that you've lived in, that your kids go to school in, to find employment if the relationship doesn't work out, dilution of equity if they continue to bring in additional capital partners, buyer illiquidity, quality of the buyer's equity, and reputation risk that you don't even know about. There is a lot below the surface on deals like this, and we make sure that our clients are well informed and that they're making a well-informed decision with who they want to link their life's work with. Final thoughts on this. We really get the opportunity to work with folks that come to us with really nice businesses, really nice bones, and they entrust us to help them prepare their business for sale. And what I like to think about, I had a contractor help me with my kitchen. This is not my kitchen, but you get the idea, right? I mean, this is, you want to look like the kitchen on the right. You want to be the one that's highly desirable. And these offers show up when you are least prepared. So we strongly encourage you to prepare your business for sale, to maximize the value. We know that running a business is messy and that it's always in motion. I mean, you got de novos coming out of the ground, you got a pipeline, you got future growth opportunities. You saw COVID's impact, doctor changes, like revenues are up, we got to explain them, revenues are down, we got to explain them. We work with you to help craft that story that explains away the changes and undulations in normal business and makes your business irresistible for all the buyers in the market. In short, we really help you win to address your business for success and going out to the broader market. It's easy to talk about. I think it's nice to look at some examples as well. We had a group come to us, a 2-location orthodontic group with an offer in hand, took that deal to market and were able to bring our client a 45% improvement over the unsolicited offer that he had received. It was a fun transaction. It was great to work with Dr. Bennett, and he is a forever fan of the work that we did and truly sees the value in what we brought to the table. Another group we worked with recently was Dr. Amy Jackson's Orthodontics of South Texas. She had a 5-location group, had an offer in hand from a specialty group. We were able to work with her and over the course of a pretty swift transaction, improve her offer by 63%. Look, TUSK is going to pay for its fees. We certainly take care of our clients and love doing so. So in the specialty space, this is what's going on. You have unsolicited offers. Before you just sign them and take them, know that we can help. So finally here, if you certainly can take that unsolicited offer. But I guess I just pose you one last question: is it, would you rather have 100% of a grape or most of a watermelon? Thank you so much for your time this evening. We are always here to help, always here to answer your questions that you may have. If you would like to reach out to us, if you are sitting on an unsolicited offer and you want to have someone take a look at it, please go to our website, tusk-partners.com, click on sell, get a free valuation report, and we will review your current unsolicited offer. We are picky with who we work with. We're only going to work with clients where we can meet or exceed their expectations. We've got an incredible team here at TUSK that can help you with that. Ryan Mingus, Kevin Sauer, Maggie Jarrett. These are the ones who are going to help maximize the value of your life's work. I'm going to leave this up for a minute, check in to see if we have questions and how we're doing on time, and then I'll be right back. Okay, back now, getting the nod from the producer. We are out of time, but if you can reach out to Ryan, Maggie, or Kevin, they will certainly answer any questions you have. Congratulations on the business you built. They are spectacular. There's no better time to own the business that you have, as valuations are at all-time highs. I look forward to seeing you on the next webinar, and thanks for your time this evening.